Exactly. Very good. 7,000. And what is the gain the company should record on the sale?
Oh.
The gain is 7,700, yeah, minus 700, and that minus 7,000. Sorry, and that equals 700. Yeah. So the correct answer is D. Does that make sense? Is clear?
Yes, it's clear.
Okay, super. That's good. Do the others have questions, or is it also clear? Okay, thank you, Ray John. That's the next one. Try to use the next one. Try to use this one. What is Hill's straight line depreciation for the year ended December 31st, 2016? And what is the book value on December 31st, 2016? What is the straight line depreciation for the year ended 2016? And what is the book value on December 31st, 2016? What is the depreciation for the 2016? I think you already said that. What is the depreciation? What is the depreciation per year? I think Liang has already said it. Can you repeat it? It's 800. Yeah, 800 is the depreciation for every year, because we're talking straight line. This is straight line. That means every year it's the same. Yeah, in every year it's the same. So 2016 is the same as 2017. It's always the same. It's straight line. It's depreciation is 800. Yeah, depreciation is 800. It's 800. And what is the book value at the end of on December 31st? Yeah, this is here. If this is the time, this is the time. Here we have January 2016. And this is December 2016. What is the book value on December 31st, 2016? Think about it. What does book value mean? Exactly, yeah. So Shen, 7,800. 7,800 is very good. Yeah, this is correct. But I would prefer if you use your microphone the next time. Yeah, so Shen, very good answer. 7,800 is correct. Because this is the purchasing price minus depreciation of 1 year. The next question, requiring that an employee with no access to cash do the accounting is an example of which characteristics of internal control, assignment of responsibility, competent and reliable personnel, monitoring of control, or separation of duties. What do you think? No one? Okay, it's a separation of duties, because if you do not let the same person do the accounting and the cash handling, then you separate duties, and that is good because you prevent fraud. Yeah, you prevent fraud if you do not let the same person do both the accounting and the cash handling. Then you prevent fraud. That's the next one. A company called Sabic invests in 100,000 Apple shares. Sabic expects to hold these shares for a medium term and not trade actively. How should SABIC classify the investment? Fair value through other comprehensive income, affiliates, consolidation, or fair value through profit and loss? Think about it and then tell me your answer.
I think it's A, because its aim is not trade actively, so not for the money. So I think it's A.
Yeah, very good, Liang. It's A. It is not affiliates and consolidation. Why? Because it is only a small number of shares. Yeah. If you compare 100,000 Apple shares to the total of numbers of Apple shares outstanding, I mean, Apple is one of the biggest companies in the world. It is only a small stake. Yeah. That's why we can say these two are not correct. Yeah, because affiliates, which means equity method, is 20 to 50% ownership. Yeah, so this is not right. Yeah, so this cannot be right. And consolidation means more than 50% ownership. Yeah, more than 50% ownership. 100,000 with 100,000 Apple shares, you never own more than 50% of the company. So C is also consolidation, is also not correct. Yeah. So then there is A and D left, and as Liang correctly says, the company SABIC does not trade actively. Yeah. If it were to trade actively, D would be correct, but it isn't going to trade actively. So A is correct. It's fair value through all other comprehensive income. Yeah. Very good. So this is the next section. And here we're talking about accounting for international operations. Yeah, accounting for international operations. With international operations, we mean exchange rates. Yeah, we have to, with international operations, we have to deal with currencies, and we have to deal with exchange rates. Yeah, currencies. And exchange rates. And there is a a standard in the international IFRS, which is called IAS 21. And it deals with the effects of changes in foreign exchange rates. Yeah. And it is there to account for businesses across national boundaries, because if you deal with business across national boundaries, then you have to deal with foreign currencies and you have to deal with exchange rates. Yeah. In Germany, for example, we have the euro. Yeah. And if we deal with, I don't know, with China, yeah, or with the United States, then we have to deal with a foreign currency. Yeah. And with an exchange rate between the euro and the US dollar or whatever. Yeah. Here you see how the euro has changed against the US dollar. And you see that it is quite volatile. Yeah, it changes a lot here from 2006 to, what is this, 2016. It changes a lot by about, what is that, by about 30% or so. Yeah. And this really can matter. I mean, think about, you're selling something here in 2014. Let's say you're selling something in 2014, and then your selling price. We're talking about a company which is based in Germany, and the selling price is denominated in US dollar. That means actually when the dollar appreciates and the euro drops so dramatically, that means actually that when the customer is paying, let's say the customer is paying here in 2015, then you get much less for your much less euro for your US dollar, and this is a bad thing. Yeah. But it can also be the other way around. And there are several factors which influence exchange rates. Yeah, for example, inflation rates influence exchange rates, or also interest rates. Do you also know of other factors which influence exchange rates?
Policy.
Yeah, the policy, or yeah, very good. And political stability, current account deficits, these are all factors. What? Yeah, the general economies. Yeah, policy. That's you can economies or economic growth. Yeah, I write economic growth. Very good. Economic growth. current account deficit, whether a country has more exports or imports. Yeah, this is current account deficits. What else did we have? Political stability. Yeah. So very, very good. This is what is called the Big Mac index. Have you heard of the Big Mac index? Did you hear of the Big Mac index? Before? It shows whether a currency is over or undervalued. And here, this is the Big Mac index a couple of years ago. And actually, it shows what one Big Mac costs in US dollar. Yeah, what one Big Mac, because the Big Mac is a product that you can get everywhere. You can get it in Switzerland. You can get it in Brazil. You can get it in the Euro area. You can get it in the United States. And you can also get it in Malaysia or in China. Yeah, so the Big Mac is a product that is the same in every country, but the price, if you compare it in US dollar, yeah, is different. So what does this Big Mac index, if you look at the chart, what does this Big Mac index tell you about the currencies of, for example, of Switzerland, of the Euro area, but also of China? What does it tell you about these currencies? Yeah, you measure the exchange rate between two countries. And what about here in this example? What about China? Is the Chinese currency, the yuan, is it cheap in comparison to the US dollar, or is it rather expensive? Is it the yuan or the renminbi? How do you call your currency? Is it yuan or is it renminbi? RMB. Okay, the RMB. Is it cheap or is it expensive? If you look at the graph,
I think
it's relatively cheap. Yeah, here it says that the Big Mac in China costs $2.18. Yeah, this is a I think this graph is from a couple of years ago, maybe 4 years ago or so. But if you compare that to the United States, in the United States, the Big Mac has cost $3.71. Yeah. In the Euro area, the Big Mac was even more expensive, with $4.79. Yeah. Does that make sense?
Yes, it's both.
Yeah. Okay. All right. Do you have a question?
No.
No. Okay. Then we can go on. And here you see short-term interest rates. Yeah, this is yeah, Ray Chan, you're right. This is a relative value. It has to do with relative value. It shows the relative value of a currency, and the relative value in this case of the renminbi is relatively weak. Yeah, that means that it is good for Chinese companies to export things. On the other hand, the Swiss franc in Switzerland is very expensive. Yeah, so it is actually bad for Swiss companies to export things, because it is very expensive. But it also means that, at least in theory, it means that there is the possibility of arbitrage. What does arbitrage mean? Arbitrage means that a person from one country goes to another country which is very close and buys the product cheaper. Yeah, for example, Switzerland and Germany is pretty close. So if the Big Mac becomes even more expensive, then people from Switzerland who live very close to the border to Germany, then they could go to Germany and buy their Big Mac there. Yeah, which should drive prices more towards equilibrium. Yeah, which could kind of force which is arbitrage, and arbitrage means that prices of the Big Mac should be not so much different from country to country. Yeah, so but you see that it doesn't work perfectly, of course, because it is too expensive, for example, to fly to China just to get a Big Mac. Yeah, and that's why this arbitrage doesn't work perfectly, and therefore we have these differences between the relative prices. Yeah, relative value. This is correct. Very good, Ray Chan. Okay, I would suggest we do a break here, and we see each other in 15 minutes.